Hello everyone, welcome back to Girard's Monthly Market Outlook. I'm Jim Jacobson, and with us again today is Chief Investment Officer Tim Chubb. We have three things to cover today. One, the Fed's recent meeting and their upcoming meeting at the end of this month. Number two, the month of October and its scary history. And number three, corporate earnings. So Tim, the Federal Reserve just held one of their policy meetings. What did we learn?
Yes, we just got through the policy meeting of the Federal Open Market Committee for the month of September. And the Fed cut rates. It was to be pretty much expected, priced into the markets. It was a quarter-point rate cut, which was really trying to, as they explained in July when they cut rates for the first time this year, to really extend the economic cycle. And we've had some weaker data throughout the year, I think largely as a result of the trade and geopolitical uncertainties, especially outside the US and the Eurozone. But this rate cut, again, was to do an insurance cut, more of a preventative policy to ensure that we're stimulating the economy and keeping the economic cycle alive.
And then looking forward at the end of October, they meet again. What might we expect coming out of that meeting?
Yeah, so the second to last meeting of the year, there won't be one in November, but there will be one in December. And I think it's up in the air with whether or not the Fed will cut rates at this point. The data has been pretty strong recently, and I think we would have to see a meaningful weakening in order for them to cut. But right now, consensus in the market anyway, as far as Fed fund futures, they are expecting one more rate cut to finish the year. But I think the Fed will have to remain data dependent and see if we see continued weakening in the economic data to really warrant that. So Jim, October tends to be this month that really gets sensationalized by the media as being this scary month, and maybe it's because Halloween's right around the corner. But why don't you tell us a little bit about what the past has shown with the month and why it might not be so bad?
Well, exactly. October has this reputation for being the end of the world for stocks, and really it's not that bad. Maybe it is. So the bottom line is October has had four monstrous bad periods. October 29, October 87, again the 0102 crash, and then October of 2008. But so many of those Octobers, in fact really all of them, had economic indicators and economic events leading into those periods. It wasn't that the month of October itself was terrible. It was the economy and events leading up to it. So the bottom line is September is statistically actually a worse month than October is. October tends to be a fairly flat month. And if we pull those four particular years out of it, October's not bad at all. But as you mentioned, the media likes to play it. It's a great headline. People dial in, they tune in, they listen in, and that is what sells the headlines.
Yeah, seasonality is always something that we're trying to combat with clients, and just understanding what drives that seasonality. And oftentimes it's just not simply a meaningful predictor of what is to come for the month.
Exactly. So as you mentioned earlier, the Fed has a meeting coming up late in the month. Probably there'll be a little bit of give and take as we get up to that meeting with some expectations being built up, but there doesn't appear to be anything on the horizon that is going to cause the end of the world. Okay, so Tim, we have the fourth quarter coming up. Taking a look back, what can we expect to hear from third quarter earnings?
Yeah, so in October, third quarter earnings kicks off. We're expecting to see actually a decline for the third consecutive quarter in a row, about 3.8% right now. It's not unlike a lot of these companies to forecast lower growth or decline in earnings, but ultimately beat expectations. I think I mentioned I call it the Wall Street two-step. If you set the bar low enough to jump over it. So right now it's 3.8%, but as the quarter goes on, we could potentially see earnings decline less than that, almost 4%. But overall, it's due to a higher base. Last year was an exceptional year. We saw the earnings growth over 20% because of tax reform, a faster growing economy than is the case so far this year. So it's not to be completely unexpected for us to take a little bit of a step back this year in light of the lower growth and what a year last year was.
So it's not like we're really plunging backwards. Last year was an overly large gain, and now we're just sort of resetting back to what would be a normal glide path.
Yeah, most definitely. I saw some recently some interesting research from FactSet. It's not unusual for companies to comment on geopolitical events or some corporate initiatives that are really impactful for their business and impactful for investors. And between mid-June and mid-September, they actually saw on corporate conference calls within the S&P 500 companies the term ESG, or the environmental social governance, just the words ESG jump about 100% between that period of time. And so I definitely think it's great to see, and also interesting to see that companies are taking a greater initiative to focusing on what investors are caring more deeply about, being the environment and some of these social and governance issues.
So it's not just earnings. There's the holistic health of the company is maybe a way to look at it.
Definitely. I mean, we look at years, not quarters, and so I think it's really important for these companies to broadcast a lot of those views longer term, which could impact their customers, their consumers, the world around them, and also how it relates to earnings moving forward. So,
well, thank you. That makes a lot of sense. Thank you once again for joining us, everyone. We look forward to seeing you again next month.